Welcome to the Deep Dive. We're the show that takes all the noise, the articles, the data, the notes, and boils it down to what you really need to know fast.
Get you informed quickly.
Exactly.
Yeah.
And today, we are plunging into Target's recent Q2 2025 earnings report. Now look, these financial reports, they can feel like wading through mud, right?
Yeah.
Just dense.
Oh, absolutely. Numbers, jargon. It's a lot.
So our mission today, cut through that. Find the real story, keep it simple. And there's this fascinating paradox we need to unravel.
Yeah.
Target seems to have, quote, beaten expectations.
Yeah.
But then the stock took a nosedive.
Right.
A big one.
Right.
So what's actually going on behind those numbers? That's the mystery we're tackling, trying to give you that clear, simple picture.
That's right. And, market reactions often aren't simple at all. They seem straightforward maybe on the surface, but
Never are.
yeah. So we're going to look past those headlines, really dig into the data, and understand the why. Why did the market react that way? The goal here is just a clean, actionable breakdown for you, so you can grasp what really matters from Target's report without getting totally lost in every single detail.
All right, let's do it. Let's unpack this puzzle. The quick headline from everything we've read, it's pretty weird. Target slightly beat on revenue and adjusted EPS. Sounds good, right? Like, that's what investors want to hear.
Usually, yeah.
But, and this is the kicker, despite those beats, comparable sales were still soft.
Yeah.
And then there was some unexpected leadership news that seems to have really spooked the market.
Ah.
The result, the stock dropped pretty hard right after the report. So the big question for you today is, how does a beat lead to a stock falling off a cliff?
It's the million-dollar question, isn't it? And to get there, we really need to start with the core numbers, just lay the foundation.
Okay, let's get the basics down.
So net sales, they came in at $25.21 billion. That was actually down a bit, roughly 0.9% compared to last year.
Okay, so a small dip in overall sales.
Right. Now, comparable sales, or same-store sales, this is super important in retail, It tells you how stores open at least a year are doing. Kind of an apples-to-apples look.
Yeah, the health of the existing business.
Exactly. That number was minus 1.9%. Now, that was better than the quarter before, which is even more negative.
So improvement, but still shrinking.
Precisely. Still firmly negative territory. Shows that demand is, well, still facing challenges.
Got it. What about profit?
Okay, so adjusted EPS, that's the earnings per share figure, but it's non-GAAP, meaning management adjusts it, takes out certain items to show what they see as the core ongoing performance.
Right, their preferred view.
Kind of. They reported $2.05, and that was a tiny beat. Consensus was looking for maybe $2.04.
Okay, so they squeezed out a penny more than expected there.
Yeah, but then this is important. Management also pointed out that operating income was lower year over year. Some reports have it falling like 20% down to about $1.3 billion.
Whoa, okay. So operating income, that's the profit from just running the stores, basically, before taxes and stuff.
That's a good way to put it. Core business profitability. And interestingly, they did maintain their full-year guidance, didn't lower it.
So mixing signals there. Confidence, maybe, but underlying profit pressure.
You got it.
So taking all those numbers together, the slight EPS beat, but negative comps, falling operating income, what story does that actually tell us about Target's health before we even get to the market freaking out? Is it struggling or just adjusting?
I'd say it's a nuanced picture. Definitely signs of strain. That negative comp figure, it shows top-line pressure. People aren't buying as much at existing stores.
Right.
And the drop in operating income, that points directly to pressure on profitability. Margins are getting squeezed.
Makes sense.
But that EPS beat, tiny as it was, plus maintaining guidance, it suggests management is pretty disciplined on costs. They're managing the controllables to hit those bottom-line targets, even when sales are tough.
Okay, so operational grit, maybe. Not a complete disaster, but definitely navigating headwinds.
I think that's fair. It shows a certain amount of operational control, yeah. Not a full-blown crisis, perhaps.
Okay. So with that context, let's shift a bit. What was actually good here? Because despite the stock drop, it wasn't all bad news in the report itself, was it?
No, absolutely not. And this is where it gets interesting.
Yeah.
That small beat on EPS and revenue, even if just by a hair, it does suggest, like we said, better execution, tighter cost control. That's something.
It shows they're pulling some levers correctly behind the scenes, right?
Yeah.
Squeezing out profit where they can.
Exactly. And beyond just those headline beats, management highlighted other positive signs, too. They specifically mentioned better traffic in stores.
Oh, interesting. More people actually coming in.
Yeah. which is a big positive indicator for any retailer. It means people are physically walking through the doors more often. That could be down to store remodels, the in-store experience, the product mix.
Foundational stuff. You need feet in the door first.
Absolutely. It's step one. More traffic could mean more sales down the line, potentially.
Okay, so more traffic. What else did they point to as a positive?
They also mentioned seeing early signs of recovery in certain categories, specifically called out kids' products and home decor.
Ah, okay. Those discretionary areas that got hit hard.
Exactly. Things people cut back on when money got tight. Seeing some life there suggests maybe consumer sentiment is shifting a little, or maybe Target-specific efforts in those areas are working.
Kind of like green shoots.
That's the term, yeah. Early positive signals, green shoots. But, and this is the important caveat, they need to keep growing. It needs to be sustained.
Right, one swallow doesn't make a summer.
Precisely. It's like seeing the first couple of flowers after winter. Promising, but you're waiting for the full bloom.
So these are potential bright spots then. Signs of maybe a foundation being laid. They're working on the customer experience, getting folks in, managing costs. Sounds like they're trying to adapt.
Yes, definitely. And you have to give them credit for those efforts, especially now. But, and here's where the fascinating part comes in. While those positives were there, the challenges didn't disappear. They were still pretty significant. That comparable sales figure, even though it improved, was still negative 1.9%.
Still shrinking sales at existing stores.
Right, which tells you demand is still soft overall, especially in those bigger discretionary areas like apparel, general home goods, not just the specific niches they highlighted.
So people are still cautious about buying non-essentials.
Seems like it. And that puts ongoing direct pressure on top-line growth. It's a reflection of the broader economy still weighing on people's wallets.
And what about the profit side again? You mentioned operating income was down year over year. Was that still a big worry despite the little EPS beat? How do those fit together?
It absolutely was a worry, and it's a key tension here. Even with that tiny adjusted EPS beat, the actual operating income, the core profit from the business was down significantly, around 20%.
Wow.
That screams margin pressure. Think about it. Even if you manage costs elsewhere, if your core operations are making less profit per item sold, that's tough.
Why would that happen?
Yeah.
More discounts, higher costs.
Could be a mix of things. More promotions to clear inventory, maybe higher sourcing or labor costs they can't fully pass on, or maybe people are just buying lower margin items.
Right.
It's a fundamental hit to profitability.
Even if they manage to hit that adjusted EPS number through other means.
Exactly. So it raises this important question for anyone looking at the company. How do these persistent bad signs, like margin pressure, weigh against the good signs, like traffic? You have to look at the whole picture, not just cherry-pick the beats.
Right. Okay, so we've got this mixed bag, good, some execution wins, traffic up, little green shoots, bad. Overall sales still down, margins getting squeezed. If the numbers themselves were just kind of, a mix. What was the ugly factor? What really overshadowed everything and cratered the stock?
Ah, yes, the ugly. This gets right to the heart of that paradox we started with, the thing that truly sent the stock tumbling.
Yeah.
It was the CEO succession news.
The leadership change.
Yes. Target announced that Michael Fidelk, who's been a longtime exec there, currently the CFO, would take over from Brian Cornell as CEO.
Okay. Internal promotion, sometimes that's seen as stability, right?
Sometimes. But here's the crucial ugly part, the expectation mismatch. Apparently, investors were really hoping for an external hire, someone from outside the company.
An outsider. Why?
They wanted a shakeup. The market sentiment, from what we're gathering, was that Target needed a disruptor, someone to come in with a totally fresh perspective, a bold new strategy to really tackle those sluggish sales and margin issues.
Like they needed a jolt from the outside to reignite growth.
Precisely.
Wow.
The feeling was maybe an internal promotion signaled more steady as she goes when investors wanted something more radical, a real turnaround narrative. So when they announced Fidelk, who by all accounts is a capable executive, strong finance background, that disappointment, that unfulfilled desire for an outside change agent, that seems to be what directly triggered the sell-off.
Wow. So it wasn't really about the Q2 numbers themselves, but about the future direction signaled by the CEO choice.
It really looks that way. The market reaction was so immediate, so dramatic. You mentioned the double-digit drop in trading.
Yeah, it was steep.
That really underscores how much sentiment, strategy, and leadership perception can outweigh the actual reported numbers, especially in this market.
So, boiling it all down, keeping it simple for everyone listening, what's the core takeaway?
The core takeaway is that the market freaked out less about the actual Q2 performance, which was, okay, technically a beat, and way more about what the leadership change implied.
A lack of the bold strategic shift they wanted.
Exactly. That expectation gap was the real driver. It shows that sometimes the biggest news isn't in the spreadsheet, it's in the signals about future strategy and leadership. Perception trumped the immediate financials here.
That makes sense. So wrapping this up, the key lesson from digging into Target's Q2 seems to be, even if a company hits or slightly beats its numbers, these broader things, strategic decisions, investor sentiment, especially around who's in charge and where they're taking the ship, could just have a massive immediate impact on the stock.
Couldn't have said it better.
We aim to keep it simple by finding that core driver. And yeah, it wasn't just the earnings data this time. It was the narrative, the unmet expectations.
And if you connect that to the bigger picture, it just reinforces that understanding a company, its stock, it goes way beyond the financial statements. You have to grasp market expectations, psychology, strategic direction.
The story matters.
The story matters hugely. This Target situation is a perfect example of how context and narrative can sometimes be even more powerful than the raw numbers. It's about what those numbers imply for the future and what leadership signals about that future.
Right. Okay, so let's leave everyone with a thought to chew on. What does this whole Target episode tell you about how much leadership choices and just pure investor feeling can move markets, maybe even more than the black and white profit numbers? How much weight do you give a CEO announcement versus an earnings beat or miss? And maybe think about what other subtle signals, beyond the headlines, might be influencing the stocks you follow.
Good questions to ponder.
Definitely. Thanks for joining us for this deep dive.